Alright guys, 2 more days to 2025 and let's strap ourselves in. And let's end the year with a big financial warning. And if you think we'll have a placid start to 2025, it's really time to readjust those expectations. Now during Biden's term, he launched a bunch of crazy spending plans. The CHIPS Act, the Inflation Reduction Act, and those are basically code names for government spending that only jacks inflation higher. But let's have a sober moment here. It's not going to get any better under Trump. In fact, the borrowing could get even worse, especially with his plan for global trade war. During Trump's first term, he increased the debt by $7.2 trillion. By the end of the Biden regime, I can expect his debt to fly past 7 trillion as well. Now, the biggest problem the US has is a spending crisis. Most of all the deficits, the spending, they're all baked into the cake. They are on entitlements, defense spending, and healthcare. And you can't cut those away without the entire system collapsing. The global financial system is built on debt. This is the truth, and eventually, we're going to reach two endgames. Either the debt will be defaulted on, which leads to total catastrophe, or the debt will pile up even higher and higher, and as a consequence, the value of money gets debased. Eventually, you'll have to print money to devalue the currency to pay back all your obligations. US government debt is over $36 trillion today. This accounts for nearly 35% of the global debt pile, more than one third. It's more than double that of China, 3 times of Japan, and twice as much as the EU. And if this house of cards implodes, global bond markets around the world will collapse as well. So before you head to your New Year's Eve party, another silent countdown is happening, which is the day of default, the Financial Day X event, where mushroom clouds of dollars just start appearing out there. And it's not just me calling for the end of the world. Yellen, the US Treasury Secretary, is also sounding the alarm bells. She has nothing left to lose now, and she's shouting from the roof. The US Treasury is about to hit the wall in mid January next month. The debt ceiling is once again about to be breached. It's a reminder that the borrowing will never end, and with yields rising higher, we can expect this to be a yearly event going forward. In her letter, Yellen admitted things are getting out of control. On January 2nd, 2025, the new debt limit will be established at the current amount of outstanding debt. The ceiling is at $31 trillion today, which means there would be an incredible spike up to $36 trillion in a matter of weeks, and that is at the minimum. To avoid breaching the limit, Yellen will take special accounting maneuvers as well, which reeks of desperation here. Now, weeks ago, Yellen came out apologizing for the deficit, but wasn't she the one who executed Biden's borrowing plans? When the US Treasury announces accounting maneuvers, we have to pay attention to this, and I'll simplify it and remove all the technical BS so that you understand what's going on here. The Treasury can draw down their cash balance to pay their obligations in an emergency. In other words, Yellen could draw down the piggy bank to prevent an obligation collapse. Now, you might be thinking, isn't this normal Treasury operations? No, not really. They are supposed to have sufficient funds in the current account. And if you don't, you get dangerously close towards a spending freeze. The operating balance today is around $730 billion. Sounds like a lot, but it really isn't. Not at the rate the US government burns through money. In May 2023, this balance almost went to zero. It dropped to just 37 billion, which means the US government was a step away from being broke. Now, spending obligations would break, including all the interest payments on the debt as well, which would lead to a technical default on Treasury bonds. Day X, the day of reckoning, would come. Now, it's likely that Yellen would just kick the can down the road. The debt ceiling would be raised again, but draining the Treasury account could still lead to a bond crisis. And this won't be pleasant, especially when yields are starting to rebound. We have already seen it in the markets over the last 2 days. Remember when stocks fell by 2 to 3% last week? And that's because bond yields defied gravity and they started to rise higher and higher. This chart shows us why Yellen's emergency maneuvers can be a problem. Since 2020, the Treasury balance has fluctuated like a roller coaster at Six Flags. It's ridiculous. from near zero to over $500 billion, then down to near zero once again, and these fluctuations are extremely demanding on the bond market that's supposed to be boring and stable. As a result, we're going to have yields bouncing around and markets getting increasingly volatile. And just think about it. If your balance drops to near zero, the knee-jerk reaction will be to borrow more in a hurry. Yellen or the next Treasury Secretary could unleash a tsunami of bonds which could raise yields even higher. Even if we ignore the damage to global markets, this won't be great for the US economy either. Borrowing costs would fly up in a jiffy. And there would be consequences for this. What if the US actually defaults on the debt? In 2013, the Federal Reserve themselves did a study on this. What if a temporary default occurs for just 1 month? What would happen to the US economy? Well, it won't be pretty. There would be financial devastation if a default lasted for just 30 calendar days. Treasury yields would fly up by 80 basis points. Corporate borrowing costs will explode by over 2%. In addition, stock prices will collapse by 30%. The US dollar will also drop by 10%, and that would translate to higher import costs for the US. Everything in Walmart and Dollar General would fly up. Industrial inputs would get more expensive. The sticker price on cars will increase. US consumers would get clobbered hard. In no situation can the US Treasury allow a default to happen. Yellen, Powell, or whoever next, they'll have to inflate the debt away. There can be no other alternatives. So in 2025, the debt issuance will have to go up. Now, I don't believe for a second, for a moment, that Trump would allow a default under his regime. So the next 4 years, they're still going to be inflationary. The markets are starting to price in this reality. They know the US has a spending problem, and investors, they are demanding a higher return. And a big shout out to our sponsor today, Indigo Precious Metals. When it comes to buying gold and silver, I trust Indigo Precious Metals in Singapore. They have made investing in precious metals safe, fast, easy, and simple for both small and large scale buying. I've been stacking gold for over a decade now, and I've learned two things when buying. You want to buy authentic gold bullion, and you want to buy it at the lowest premium possible to stretch your dollars even further. And I'm glad to say I found both of this at Indigo Precious Metals. Indigo Precious Metals is a leading retailer in Singapore. They specialize in physical gold, silver, and platinum. They are my one-stop shop when it comes to buying bullion. Their prices are sharp, and they have the best brands on sale, and I can test the gold on the spot. So if you're looking to make your first gold purchase, Indigo Precious Metals is the best place to start. Whether it's 1 ounce or 1 kilo, this is the reputable dealer you are looking for. So take action today. Click on the link below and enjoy a discount on your first purchase with the code SeanFu. Start your gold stacking journey today. Even as power cuts rates down on the short end, bond investors are revolting. Yes, Fed funds in blue, they are now under 4.5%. But how is that a win? The 10-year has flown up to 4.6%. The yield curve has uninverted, which means this could be the normal state of affairs going forward. Long-term borrowing costs are rising, and we could very well see a 5% handle next year. And that would be a shock for the markets. And when we analyze interest rates and the US economy, it's more important to look at the 10-year. That is the benchmark to which almost every other borrowing cost they are pegged to. Mortgage rates, credit card rates, and personal loans. If the 10-year goes up, this makes living in the US much more expensive. Now focus on the yield curve in red here. It shows the latest update last Friday. Compared to September, yields for the 2-year all the way to the 30-year bonds, they have flown up, some by over 100 basis points. The 30-year borrowing cost itself is dangerously near 5%. And this opens up a whole can of worms for the US economy. Trump has to reduce spending to drive yields down. The higher they go, the entire plumbing of the financial system starts to get undone. But Trump has sandwiched himself into a global tariff war. The mission of his administration is simple: bring back US manufacturing at any cost.
Vote for Trump and you will see a mass exodus of manufacturing from China to Pennsylvania, from Korea to North Carolina, from Germany to right here in Georgia. They're going to come to Georgia from Germany and lots of other places.
Trump has made it crystal clear that US manufacturing is going to return, and you can count on that happening. But just like Thanos snapping his fingers, the key question is at what cost? Because there will be a tremendous cost of driving the debt higher, and not talking about it would be disingenuous. And here's what Trump's reshoring sounds to the world. Trump wants to borrow money from the world to force companies to reshore to the US. By funding the US government in 2025, the global economy, they are funding their own de-industrialization. Sooner or later, countries including the G7 will realize this. Now, since 2015, a dangerous trend has been starting. Despite the dollar being the reserve currency, countries around the world, they are holding fewer and fewer US bonds. We are witnessing a repatriation of global assets from the US to other stores of value, and this will only continue. US bonds by foreign central banks have dropped from 35% of total debt holdings to nearly 20%. It's a big decrease. During the same period, gold holdings as a percentage of currency reserves have increased from 12% to nearly 20%. And if Trump continues to threaten the world if more sanctions happen, it won't be a surprise if this number goes higher. We could very well hit back to the 1990 levels where gold was 30% of total currency reserves. And these are all the big macro effects of the last decade. We already have currency debasement and asset confiscation. Now, if you add in a trade war into the mix, countries would be less willing to keep funding Washington like before. And this would, of course, result in higher borrowing costs at least for the next few years. And let's talk a bit about the US equity markets because the higher rates go, it slows down the pace of economic growth. Now the S&P is up by over 25%, fantastic, hitting 6,000 before retracing back. Now that's incredible, but it's not because earnings have gone up. In fact, it's more or less flat. It does suggest that valuations are out of whack, which poses a big risk to US stocks. If this fairy tale narrative suddenly flips, the potential crash could look really ugly. As we speak, US equities are 3 standard deviations higher than global stocks. This has never happened before in history. It's higher than the Nifty 50 bubble in the late 1960s. Valuations today are even crazier than the dot-com bubble just before the collapse. Money has been leaving global stocks for the US over the last 20 years. And can this continue? Sure it could, but it can't continue forever, or the US market, the US stocks, will comprise 100% of the world market. It's mathematically impossible. The higher yields go on a 10-year, the greater the chance of a sell-off. We could really have a retracement back down to earth. And what could directly affect bond yields in the US? Well, the amount of borrowing, plus the coming trade war. Now, if Trump does something radical like a global 25% tariff, then we could see panic in the bond markets. But beyond this sudden puke, the picture is going to be inflationary long term. The US debt would still continue to climb. There's just no way to cut spending anymore. It's the combination of higher rates and uncontrolled deficits that's going to push us off a cliff. The interest expense on the debt is slated to be 4.1% of GDP by 2024. And this is only sustainable if, and this is going to be a big if Trump can raise economic growth enough. But if he can't, the US economy would grind closer and closer towards eventual default. And a lot will be outside his control. How will the world respond to his trade tariffs? Will China counter and launch its own economic war? We just don't know yet. So this is my last video for 2024 and really great to have you guys on board the USS Armageddon. And let's count our blessings that the world is still in one piece. Radiation levels haven't gone ballistic yet. So have a great end to the year and I'll see you in 2025. Get your tinfoil hat out because it's going to be insane. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.